which came through for the first quarter. They witnessed a seasonal hiccup in asset quality but managed to arrest declining net interest margin trend. Assets under management growth is also come in at what is basically a 7-quarter low. To discuss more on their performance, we have Suresh Srinivasan, Iyer, Managing Director and CEO at Canfin Homes. Mr. Iyer, good morning. Good to have you with us here. Thank you very much for your time. If I can begin by asking you, your sanctions growth has basically outpaced what you've disbursed in the quarter. Could you tell us what is the reason behind this and how do you see both of these trending from here on?
We have actually had a steady sanctions, but disbursements, because we have some, issues in the disbursement, this keeps happening in the normal sub-registrar offices and also some delays keep happening. So last minute, delays can happen. But it has been in line with the expectations, and the growth that we had targeted about 15%, which we had given as a guidance, is what we have sticking to. So we've had a 2,000 crore target that we had set for the quarter. We are just about there in terms of the disbursement.
Okay, so 15% growth in disbursements is what you're looking at. Mr. Srinivasan, good morning. On the AUM side, your AUM growth has been strong for the last many quarters, but this quarter it's come in at 18%, slightly short of the 20% that you're used to for the last many, the preceding quarters. Can you tell us what led to that slight hiccup in terms of AUM growth, and what is the target by the end of the year?
So last year also we had 18% growth in AUM, and we had also projected or given a guidance that we'll have an 18 to 20% growth in AUM. So we are in line with the AUM target of 18 between the 18 to 20% range that we have spoken about. And as you know, the first half of the year is a little subdued compared to the second half. So the pickup will happen in the second half. But our guidance is 18 to 20% in terms of the AUM growth.
All right. Hi, Mr. Iyer. Good morning. This is Nigel on this side. A couple of questions with regard to this 18 to 20% growth. How many branches are you looking to open for this year? I think it was 10 or 15 odd. And do you think that will cut it to get this 18 to 20% growth? Or are you looking at an increase in the ticket size?
Well, we have targeted 15 branches to be opened in this year. And we are on course for that during the year. We've already identified a few branches. So this quarter, we should start seeing the branch openings happening. And in terms of the growth of 18-20%, we are already having this 18 to 20% growth. These branches normally take about a year and a half to start, delivering and reaching the kind of peak business that they normally start achieving. So the benefit of these branch openings that we are doing will come in the following years or in the second half of the year. And as regards the ticket size, yes, we are looking at a slight pickup in ticket size. Although this year it has been almost the same or almost, I would say, a little less at 22 lakhs for this quarter, whereas in the last year we had around 24 lakhs as the average ticket size. But that's more of a blip rather than anything else. That's nothing directional or intentional in that sense.
So it can increase to what level? From this 22, it's fallen from 24, 25 to 22. You're saying it could increase a little bit. What could it be?
Yeah, it could be a little more than 25 by the end of the year.
Okay.
Right. Could you talk to us a little bit about the various customer segments and where you're seeing more traction? How's the self-employed customer segment doing for you?
Well, we've not seen much of a change in terms of our, segment or the customer mix. We still have a sizable amount coming from the salaried segment only, but there's been a marginal, pickup from the self-employed segment. But that's more a normal fluctuation that is happening. Nothing major, not even a percentage point that has changed in that sense. So that's the.
Okay. Your ROAs, I just was looking at that. It's a little lower than what we saw same time last year and last quarter. It has been trending lower despite your margins improving. Can you tell us both on NIMs and on ROAs, what is the expectation?
Well, actually, compared to what it was on March, there's been a slight improvement. But yes, compared to the last June quarter, it's definitely what we had presented in June 2022. It's lower because the last year we had the impact of the rate increase, because of which our margins were squeezed during the year. On the asset side, we have an annual reset, whereas on the liability side, all our liabilities get repriced much faster. So because of that, during the entire year last year, when the rates were going up, we had a lagged effect on the asset side, because of which our NIMs and this were coming down. But now we have, now that the rates have stabilized, we have started the improvement or the effect getting seen on the asset side as well. That's why the NIMs on a sequential basis have improved during this quarter.
Yeah, Mr. Iyer, we're just a little short on time. We just wanted to understand going ahead, these NIMs which have improved, and we have the chart up for you on the screen. It's improved after a few quarters at around 3.5%. Can you hold on to these NIMs? And also ROA, I think earlier you were targeting around 2.2%, right, by the end of this year.
That is correct.
Maintain that?
Correct. Yeah, that is fine. And in fact, we should be able to maintain these NIMs going forward as well.
Okay, well, we'll leave it there. Thanks very much, Mr. Iyer. Appreciate you joining us with that outlook for the business as you see it. Well,